Many people buy cryptocurrencies assuming they all act like highly volatile tech stocks. You pick a ticker symbol and hope the line goes up. Treating Bitcoin the exact same way you treat an asset like Solana leads to poor decisions and misallocated capital. These networks operate as specialized tools, each built to perform a specific financial or industrial task. The crypto landscape is a spectrum of distinct software networks. Every protocol is engineered to solve a specific problem, and doing so requires the developer to make a significant structural sacrifice. Network developers call this the blockchain trilemma. It is the architectural reality that a network cannot maximize security, speed, and decentralization all at the same time. You always have to give up one to get the other two. To figure out which of these assets makes sense for your goals, we have to look past the price charts. We are going to evaluate the top 5 networks by looking directly at the exact architectural compromises they chose to make. We start with Bitcoin. It is the original decentralized digital money, designed to operate entirely without a bank or a central administrator. This diagram shows the network architecture, a public ledger of linked blocks verified worldwide. This structure, combined with a strict 21 million coin supply, results in unmatched security. Because these rigid rules are enforced globally, it's virtually impossible to alter the record. But that absolute focus on security and decentralization creates a severe limitation. The network is slow. It cannot process thousands of transactions a second, and it prevents the execution of complex programs directly on its base layer. Bitcoin sacrifices speed and programmability to guarantee absolute scarcity. This makes it highly effective as digital gold for wealth preservation, rather than a network for high-speed daily payments. Ethereum was built as the direct evolutionary response to Bitcoin's lack of programmable utility. Developers wanted a network that was secure, but could actually run applications. This structural layout illustrates a smart contract. Ethereum introduced these self-executing programs to integrate conditional logic directly into the blockchain. By allowing data to flow between parties automatically, developers can build complex decentralized applications without requiring a central middleman. This programmable capability triggered massive global demand. Today, Ethereum powers massive finance platforms, unique digital collectibles, and global blockchain gaming. But this massive popularity highlighted an inherent trade-off. As millions of users try to run complex applications at the same time, the immense computing demand heavily congests the network. That congestion drives transaction fees incredibly high. Ethereum operates as the industry standard for decentralized utility. However, users and developers must accept high financial premiums for access to that robust network. Solana was built specifically to solve the congestion and fee bottlenecks that plague Ethereum. To achieve this, it utilizes a unique input mechanism called proof of history. This allows the network to drastically reduce processing time, pushing thousands of transactions per second. Optimized for fast applications, fees cost a fraction of a cent. However, this immense speed requires intense node hardware demands. This naturally leads to a less decentralized network architecture than Bitcoin or Ethereum. Solana trades maximum decentralization for extreme efficiency, creating an optimal environment for high-frequency, low-cost commercial applications. Parallel to these networks is the Binance ecosystem. It offers a heavily resourced, institutionally backed solution to Ethereum's cost issues. We distinguish between the centralized Binance Exchange and the BNB Smart Chain, which hosts decentralized apps. The main advantage is seamless migration. Natively compatible with Ethereum, developers can easily port projects to an environment with significantly lower fees. The core trade-off is structural control. This system relies heavily on the central Binance corporate entity. By opting into this ecosystem, you are introducing institutional counterparty risk. The Binance ecosystem provides incredibly frictionless integration with mainstream crypto trading. It achieves this by stepping away from the pure decentralization found in other networks. Cardano takes a completely different path. It is a deliberate rejection of the move fast and break things mentality common in agile crypto development. Its core input is a strict, research-driven methodology. Every major update undergoes intense peer review and focuses on mathematical scalability. This produces an incredibly stable network, engineered for long-term institutional and governmental adoption, where software failure is not an option. The trade-off for this academic rigor is time. Features and ecosystem growth roll out much slower on Cardano than on competitor chains, creating a real risk of losing market share. Cardano trades immediate market dominance and rapid feature deployment for highly secure, long-term infrastructure. A blockchain's effectiveness depends entirely on its alignment with a specific use case. If your primary goal as a beginner or long-term investor is wealth preservation and a hedge against inflation, Bitcoin remains the definitive asset. For developers and power users who prioritize established security and want access to the largest decentralized ecosystem, Ethereum is still the standard. Active traders, gamers, and budget-conscious users looking for high transaction speed and minimal fees will find Solana or the BNB Smart Chain better suited to their daily needs. And for patient tech optimists who value rigorous peer-reviewed engineering over rapid market deployment, Cardano aligns with that thesis. Define your personal goals first, and then let the specific architectural compromises of these networks guide your decision.